Everyone thinks we are going to see a major crypto crash at some point in September, but are we? One man who disagrees. He believes we are going much higher over the next few weeks. He believes everyone has got this call wrong and the next few weeks will be massive for crypto. Why does Tom Lee think we are going much higher? Well, stocks are already hitting new highs, the Fed has only just turned more dovish, and Tom believes the reaction in risk assets has only just begun. Put those signals together and it means liquidity is being released into the system, and Bitcoin and Ethereum are standing right in front of it. Ethereum is being compared to the kind of moment when Wall Street rewrote the rules in the 1970s, while Bitcoin continues to attract steady inflows through ETFs and rising stablecoin supply. In this video, we're going to dig into why the next few weeks could be the turning point that nobody is ready for and how crypto could shock the entire market. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's start by listening to Tom Lee.
I think that markets have been holding their breath. They've been getting defensive. That's why we've been bleeding for 5 days. And so now I think there's a relief and some capital gets put to work, and it's good for equities and risk assets.
So, all right, we need to make some news here, Tom. Everyone listens to you. We're at record highs now for the S&P and the Dow. How much more can these stocks rally?
I think there's a lot of upside. Especially because, once you get an ISM back above 50, it really does argue for a broadening of markets. And I think one of the leaders probably comes from the financial sector. So I think, towards the end of the year, 6,800, 7,000 is possible.
Led by tech still?
Yeah, so I think you still want to play
this week.
Yeah, you want to be long AI and the crypto trade because those have been the market leaders. So the Mag 7, Bitcoin, Ethereum.
Every market rally reaches a moment where traders start holding their breath. That pause is exactly what Tom Lee described. A defensive stretch where capital pulls back, prices drift lower, and investors wonder if the run has gone too far. But those moments don't last forever. When fear gives way to relief, money rushes back in, and that's when the real acceleration begins. Right now, the market has snapped back from its defensive stance, equities are catching fresh bids, and risk assets, especially crypto, are waking up. The question is not whether the rally continues, but how far it can go before hitting the next ceiling. Tom Lee pointed out that the market had been bleeding for 5 straight days as capital stayed defensive, waiting for the Fed's signal. That streak broke when Powell opened the door to easier policy, and suddenly the mood flipped. Historically, these pauses often act like a coiled spring. Once the data shifts or the Fed tilts dovish, you don't just get a rebound, you get broadening. And broadening matters because it spreads gains beyond the tech megacaps and into the forgotten corners of the market. Lee highlighted the ISM, the key measure of US manufacturing. For nearly 3 years, it's been stuck under 50, signaling contraction. If it moves above that line, it doesn't just mean growth is back, it triggers a cascade where industrials, financials, and small caps start to outperform. That kind of backdrop doesn't just lift the S&P or Dow, it creates an environment where risk appetite expands and assets like Bitcoin and Ethereum, which thrive on liquidity and confidence, stand to benefit directly. This is why Lee also emphasized how small caps, financials, and cyclicals could be among the biggest winners once ISM turns. Capital that has been hiding in defensive sectors like staples and yielders starts rotating into growth-sensitive plays. That same rotation supports flows into crypto because when institutions and retail alike sense broadening, they move further out the risk curve. This is what marks the difference between a temporary bounce and the next leg of a bull market. For Bitcoin and Ethereum, the timing is critical. Liquidity is opening just as new inflows through ETFs and stablecoins provide structural support. The leadership question always comes up. Are tech stocks still the spearhead, or do new sectors take over? Lee made it simple. You want to be long AI and the crypto trade. The so-called Mag 7, Apple, Microsoft, Amazon, Alphabet, Nvidia, Meta, Tesla have been leading, but Bitcoin and Ethereum are now part of that same leadership basket. It's a striking statement. For years, crypto was treated as a sideshow compared to equities. Now it's grouped with the market's most powerful drivers. It reflects the reality of flows. Spot Bitcoin ETFs have seen billions in net inflows since launch, providing steady bid support. Ethereum is next in line, with anticipation around its own ETF approvals driving institutional positioning. The deeper story, however, is how AI and crypto are converging. Ethereum, in particular, is being positioned as a settlement layer where agentic AI systems can validate commands, authenticate humans, and execute transactions securely. Smart contracts already provide this infrastructure, and as AI systems scale, they need reliable on-chain rails. That's why Lee compared Ethereum's current stage to the US dollar leaving the gold standard in 1971, a moment that unlocked decades of financial innovation. For investors, it means Ethereum isn't just another asset in the rotation, it's becoming a core building block of the new economy, just as NVIDIA GPUs are the backbone of AI computing. From a market perspective, the combination of tech and crypto leadership makes sense. Both sectors thrive when liquidity is abundant and risk appetite is high. Broadening through ISM strength ensures that capital doesn't stay locked in a handful of names, but spills over into sectors that create real economic momentum. And when equities and industries are pulling higher together, crypto benefits from the multiplier effect of increased liquidity, stronger balance sheets, and a willingness to take on new exposure. The takeaway is not just that the rally continues, it's that the rally is entering a new stage. The 5-day bleed was a reset. The Fed's dovish stance was the trigger. Now equities are breathing again, small caps are stirring, and crypto is stepping into its rightful place as a market leader. Now, every bull market turns on the Fed, and this moment is no different. Investors had been waiting for clarity, unsure if Powell would stay tight or give room to breathe. Let's hear more from Tom Lee.
I think that it's the Fed acknowledging that the risks now are tilted for the labor market to be softening, and they want to head that off, especially because they don't think that tight labor markets are going to necessarily create inflation. That's a very good sign, and I think it means we have a dovish Fed again, and that's kind of a green light for small caps.
Small caps
and for equities.
They are working. Last I looked, small caps were up 3%. So is this what we need to really confirm the sort of broadening that comes and goes in the market?
Yeah, because I think that one of the things we should watch for is what happens to mortgage rates. But mortgage spreads are right now 360 basis points higher than the 10-year. Historically, it's 1.6 percentage points. So you could see a huge drop in mortgage rates. That's going to help housing, helps the financial small caps. And I think already the ISM, which has been below 50 for almost 30 months now, could finally go back above 50, and that's a good sign for industrials.
Although we had a discussion right on the heels of the speech about a little steepening in the curve. Is there a sense that the vigilantes are at least present, if not being necessarily vocal?
Yeah, but we could also be steepening because growth expectations are improving as well. So this could be like what I'd call a bull steepening. I'm not really sure what the fixed income terms are, but I think it's actually a positive sign for growth.
Tom Lee's take is that the message is clear now. The Fed is acknowledging risk in the labor market, signaling that softness ahead is more dangerous than tightness today. That's a major change in tone. Instead of worrying that low unemployment will spark inflation, policymakers are willing to let conditions loosen. For markets, that sounds like the return of a dovish Fed, and a dovish Fed has always been the lifeblood of small caps, equities, and crypto. Tom Lee explained that when labor risk outweighs inflation fear, you have the setup for easier policy. That shift has been confirmed by the data. Small caps, which borrow at higher short-term rates and react first to changes in policy, jumped more than 3% as soon as Powell's signal landed. For months they lagged, locked out of liquidity, while tech giants pulled ahead. A reversal here is exactly what Lee flagged as the early sign of broadening. Once small caps and cyclicals start catching up, it confirms that risk appetite is no longer confined to 7 mega-cap names. It means capital is spreading across the system. Mortgage spreads are the clearest evidence of how policy filters into the real economy. Lee highlighted that current spreads are more than 3.5 percentage points above the 10-year Treasury yield. Historically, the gap has sat closer to 1.5. That's more than double the norm. It shows how stressed the housing market has been, with financing costs keeping buyers and builders sidelined. But spreads this wide don't stay forever. If they contract, mortgage rates could fall sharply. Housing is one of the most powerful engines for US growth, pulling in banks, insurers, retailers, and manufacturers. A rebound here would not just boost small caps and financials, it would signal that the economy is ready to re-accelerate. Crypto has always tracked these liquidity pivots. When mortgage markets ease, it frees up capital that spills into equities and risk assets. The timing is critical because Bitcoin and Ethereum are already supported by ETFs inflows and climbing stablecoin supply. fresh macro liquidity sits on top of those crypto native drivers, creating a double boost. The ISM index ties the picture together. After sitting under 50 for nearly 30 straight months, a move back above that threshold would mark the end of contraction and the return of growth in manufacturing. For industrials and cyclical equities, that's the trigger they've been waiting for. For crypto investors, it's just as important. A broad economic upturn doesn't just increase risk appetite, it also adds legitimacy to the idea that Bitcoin and Ethereum are part of the same leadership complex as industrials and tech. A healthy backdrop means more institutions are comfortable allocating and the spillover effects accelerate. The conversation around steepening adds another layer. Yield curves had been inverted, flashing recession signals and scaring off investors. But Lee pointed out that a steepening driven by better growth is a positive sign, not a warning. In fixed income terms, it can be confusing, but the essence is simple. When expectations for growth rise, long rates tick higher, short rates fall with Fed easing, and the curve steepens. That tells markets they aren't bracing for collapse. They're bracing for expansion. For equities, that's a tailwind. For crypto, it's even stronger because steepening tied to growth means liquidity is not just policy-driven, but demand-driven. It's the kind of setup that extends bull runs. The context here is important. Every major crypto breakout has coincided with a dovish or easing stance from the Fed. In 2013, 2017, and 2020, rate pressure had eased or QE was running in the background. Today's setup is even more dramatic. Trillions of dollars are parked in money market funds, waiting for a reason to move. If mortgage rates drop, ISM climbs, and growth expectations rise, that cash has a path out of safety and into risk. Equities will absorb part of it, but crypto, with its ETF infrastructure and stablecoin rails, will capture an increasing share. Lee's emphasis on small caps, mortgage spreads, and ISM is not only about niche indicators, it's about the mechanics of how liquidity flows. Defensive positioning always unwinds when policy softens and growth shows signs of life. That unwind fuels risk-taking, and in this cycle, risk-taking no longer stops at equities. It flows directly into Bitcoin and Ethereum. This is why the next few weeks matter. The signals that markets have been waiting for are lining up, and capital is preparing to move. And to sum it all up, the next few weeks are set up to be huge. Stocks are running, the Fed just opened the door, and crypto is right in the middle of it all. Bitcoin, Ethereum, and the whole market could be about to take off in ways nobody's ready for. Don't sleep on this moment. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.